Look, in terms of the V-shaped recovery call that we had made, it's pretty much on track. We're getting the data which is confirming that. So if you look at the global manufacturing PMI, they are in expansion mode. If you look at global new orders trend, which is a forward-looking component of the manufacturing PMI, that's actually running higher than what we were at in 2017. And similarly, if you look at global services PMI, that's coming back towards the expansion level. So we are getting the global data points which are pretty much confirming the V-shaped recovery call that we had made. And that is essentially saying that we will get global economy back to pre-COVID levels of output in fourth quarter of 2020. And we will have DM economies getting back to pre-COVID levels of output by third quarter of 21.
Right. Chetan, looking at the data points, what are the monitorables from here on which one should have on their radar to assess the durability of this recovery? Mobility is one data you spoke about, its importance to us last time. What are some of the other monitorables in your view which we should be watching very closely?
So, Ajay, I think it's more about maintaining that pace that we have had so far. There has been an argument that the recovery that we saw in the initial period was really just a bit of pent-up demand and a bounce back from the lows. And whether we are able to sustain it from here on is an important set of numbers to track. And our view is that we will, and we kind of see that, in a number of economies now, the consumer is on a self-sustaining recovery path. We've seen a significant pickup in jobs. We've seen a significant pickup in wages. And so now the income growth itself is coming back, and that's driving the recovery. And what is being underestimated is that the first round of stimulus that was laid out in DMs in form of fiscal and monetary policy, that was quite significant. And that's still running through in the numbers and is supporting the growth in DMs. Similarly, in EMs, I think what is being underestimated is the impact of monetary easing. Monetary easing has been quite significant. Even if you take the example of India, if you just look at the central bank's balance sheet as a percent of GDP, it has expanded quite dramatically, pretty much like what we had seen in 2008-9. And India's real interest rates are, for example, right now in negative territory. So they are quite stimulative. And we think that that will continue to support that recovery going forward, in both in DMs and in EMs.
Thanks for bringing that up, Chetan. I wanted to, that particular answer would lead to my next question. How do you analyze the central bank, global central bank's stance from here on? Commentary coming from Fed. We are having policy as well here in India today, and there is a fear that there's a pause now. Rate cut cycle may enter into a pause. What are your thoughts, the way things could pan out for next couple of months? Could there be expansion on stimulus in US? Could the rate cut cycle resume in India as well?
So as regards the developed world is concerned, the central banks are still continuing to be extremely accommodative. They are continuing to make asset purchases and expand their balance sheet. And that is the most important way in which they have been providing accommodation. We expect the Fed to continue with its asset purchases to the extent to which by end of 2021, Fed would have expanded its balance sheet cumulatively by about 27% of GDP, which is much more than what we had seen in QE 1, 2, and 3 taken together. And similarly in Euro area, we're expecting ECB to continue to expand its balance sheet. In fact, we expect it to top up its quantitative asset purchase program in December. And as regards EMs are concerned, we think that most of the EMs are now largely done with the rate cut cycle. We have a few more rate cuts within EMs, but not a lot more, because we are seeing recovery in EMs also quite significantly. If you look at the data in India, for example, for the month of September, we have seen positive growth in a lot of the broad indicators, like, for example, GST collections. You look at two-wheeler sales, you look at car sales, you look at rail freight traffic, So that's indicating that the economy is coming back, and now the central bank can just hold on to those rates and not do aggressive rate cuts from here.
Sure. Chetan, since I'm chatting with you, another big event which global asset markets, all asset classes watch very closely is the US election. How are, in your view, risky assets reading the way things are panning out? How important would this event be in the backdrop of such a big crisis which humanity has been facing? This event comes in world's largest economy heading to a presidential election. How important is it, and what would you watch out for?
So there are two things that we are watching about the U.S. elections. Firstly, whether this will be a contested elections, i.e. whether you will get the results quickly in a day or two, or it will take longer time. Right now, we think it will probably be an election week, not an election month, i.e. that you will get the results within a week, because there are going to be a lot many votes coming in through mail-in process. It will take time, but we do think that that uncertainty is going to be manageable, probably lasting to magnitude of a week, but not a month. But that is what investors are worried about and are focusing on. The second is which party takes the lead and what are the policies that party prefers. Right now, our view is that we want to focus on whether there will be another round of fiscal stimulus, whichever is the political party at the top. And our view is that you have a chance of getting at least a moderate-sized stimulus after elections, if not big. So if you get Democrat sweep, you'll probably get a much larger stimulus. If you get a Republican sweep, you'll probably get a smaller stimulus. And if you get a split government, you'll still get a smaller stimulus. So in our view, there is a good chance of getting at least a smaller size stimulus. And in the meantime, the U.S. economy has actually come back quite nicely. And we think that the importance of fiscal stimulus has reduced. So broadly, we don't think that the elections will make a big dent into the growth trajectory that we are forecasting for the U.S.